In today's show, U.S. investors are piling into a historically overpriced stock market, just as the rest of the world is spiking demand for gold. Also, is the gold and silver ratio suggesting an increase in allocation to silver?
The McIlvaney Weekly Commentary covering monetary, economic, and geopolitical news events.
You want to double the amount of gold in production? This is not like running an extra shift at the manufacturing plant and cranking out more widgets. You can't get it out of the ground to meet supply. So what happens? It triggers a massive increase in price. We'll talk about this more as this unfolds in 2017 and 2018, but I think that's exactly what we have in front of us.
Now here are Kevin Orrick and David McIlvaney.
Welcome to the McIlvaney Weekly Commentary. I'm Kevin Orrick along with David McIlvaney. I was excited yesterday, Dave. I got my legacy book from Amazon. Obviously I had read the book, the pre-reader copy, but I ordered my copy from Amazon and it had been on pre-order. So I would guess that a number of people who pre-ordered the book received their book yesterday.
And I don't know why it still says backordered or out of stock, because they've got thousands of copies and they are shipping them out as we speak.
Yeah, so. I think you printed thousands of copies at this point. But now you're just getting back from a fascinating interview with a person that a lot of people know, a lot of people listen to, Dr. James Dobson on Family Talk Radio. And I believe that'll be aired in less than 2 weeks on February 27th, 28th?
That's right. February 27th and 28th. I mean, I know him because his books were part of my childhood, and at least 3 or 4 of them have been interesting in terms of the insights they've offered to raising boys, raising a daughter, having strong-willed kids, and as a psychologist, as a child psychologist, has shed real light in terms of family dynamics.
Well, and he's written a book about legacy. You guys are on the same page talking about looking forward into your family and actually looking almost into a forward form of history.
That's right. And so what we got to do in both of those shows is kind of explore the content in the book that I just finished, which is The Intentional Legacy. And it was a great conversation, and it just sort of expanded a little bit our thinking in terms of the importance of it, why it needs to happen, and sometimes why it doesn't happen.
Well, and when you were sharing a conversation that you had between recording the 2 programs about legacy as far as monetary value. We know legacy as far as the family value. You address that deeply in the book. But as far as money sometimes can ruin a family. And I think it might be worth addressing that a little bit, because money can either propel a family forward or it can destroy it.
Or repel them from each other. And, I think one of the stories that I liked in the exchange with Dr. Dobson was a few shares of Coca-Cola, which were gifted to Myrtle, his mother, by his grandfather. And those dividends from the Coca-Cola shares kept their family fed and alive through the Great Depression.
Yes.
And when his mother was in her 80s, she actually was still receiving dividends from those Coca-Cola shares, and they had increased in value. There'd been a number of share splits, and her assisted living needs were still taken care of by that original gift. And just, it makes me think there is a forward-thinking man who took care of future generations and needs yet unknown. And it has to be done carefully. It has to be done deliberately. I just think that there are many areas of neglected value. And this is one of the things that we were really discussing in the interview. The neglected values in our day and age are not the dollars and cents, the shares, or what have you. The neglected values are forgiveness, grace, creating an environment where conversation occurs on a consistent and regular basis, where family members can be on the same page.
Right.
So that when it comes to the dollars and cents,
you've already laid the relationship groundwork.
That's right. And that relationship groundwork speaks to, again, neglected value and neglected values. Now, honestly, one of the things I really want to talk about today is where the greatest value is being neglected in the financial and monetary world today. And we think of money. We think of money and we think of them as greenbacks, or if you're in some other part of the world, it's a different color, it's a different shape, but all of them are paper
Or an electronic blip on a screen. I mean, the younger generation doesn't even think of cash anymore.
And the definition of money, which is very simply a medium of exchange and a store of value, has been shifted because we still maintain the medium of exchange part of the classic definition, but we have dropped the store of value part. And this is where, again, I think gold is a currency. Gold is a currency with no liability associated with it.
Well, and let's stop there for a moment because we've shifted. You're talking about it being a medium of exchange and a store of value. Well, it can't be someone else's liability if it's a store of value. And right now, Americans are using a U.S. dollar that if somebody says, what is it backed by? The only thing you could say is, well, $20 trillion worth of debt plus the promise that they're going to print more.
Well, and the guarantee that they can increase taxes if they run out of money.
Right.
I mean, so we do have this underappreciated point that gold is a currency and it has no liability associated with it. And at this point, the world, while it appears stable, and again, I emphasize appears stable, I think this is an underappreciated aspect of real money.
Well, and people look at gold sometimes and they'll say, well, I'm just treating it as another market. You know, is it going to rise? Is it going to fall? And they'll trade in and out of that market. There's nothing wrong with that, but there's a portion of a portfolio, Dave, both you, your father, the associates here who've got thousands of clients out there, we've all recommended that about a third of a portfolio be laid as a foundation, like a foundation of a house, not worrying about whether it's rising or falling, but actually just preserving. This goes back to the legacy. You know, the foundation of a house, you can build many houses on the top of the same foundation. And I can tell you, after 30 years of working with the family, I have had parents that I've worked with that have now passed on. And they have given that gold to the next generation. And we're teaching that next generation how to give that gold to the next generation. And so talk about the preservation aspect. And then I'd like to go into the market aspects of, you know, the possibility of it actually rising.
Well, I think one of the reasons why gold is not front and center in conversations from one generation to the next is because it's neglected. And it's neglected, precious metals in general are neglected in proportion to the confidence that people have in the system, whether that is stocks, whether that is the current definition of money, whether it is the PhDs that are leading the charge as technocrats, be that in Washington, D.C. or on Wall Street.
Right. They manage the perception of complete control.
And so to the degree that confidence exists, it's something that is not needed as sort of a rock solid basis for wealth building and accumulation. So it ends up being a neglected element in conversation from one generation to the next because, quite frankly, it falls in and out of popularity and it falls in and out of seeming importance because, again, we're dealing today with the appearances of stability. We have stocks reaching like trees for the sky, and you would say in that context, why?
Well, I read something yesterday that just shocked me. I was telling my wife this last night. I said, you know, confidence in the stock market right now and in the economy is at an all-time high amongst Republicans. And it's at almost an all-time low against Democrats. Now, one side or the other is going to be right, but, you know, we've talked, Donald Trump is inheriting a stock market that is hitting all-time highs. The Americans right now are a little bit confused, but if you look at what's going on worldwide, I mean, if you were sitting in an emerging market right now or in any other market other than America, you're buying gold and you're getting out of paper.
Right. Well, so let me be very clear. The main topic that I want to cover today is gold, why and what to expect. And I think a combination of, first of all, the emerging market pressures, and second of all, the domestic or U.S. demand for gold together will raise demand for gold globally, which is likely to drive the price nuts, even in the face of a strengthening U.S. dollar in the years to come. There are reasons to believe that we'll see a strong U.S. dollar.
Well, and the emerging markets are already there.
Yeah, right. We have the first element already in play. The second, that of U.S. demand or domestic demand for gold, is likely to be triggered by financial market concerns, which admittedly are non-existent today if you are looking at the mainstream media's presentation of the facts. We'll cover that when we talk about sentiment numbers in a moment. But Citigroup's currency and gold analyst, Willem Buter, said this last week, Trump probably would do better to look at basic economics of exchange rates. You cannot have anticipated fiscal expansion and anticipated monetary tightening, while the rest of the world, by and large, is in a monetary loosening mode, and still expect your currency to weaken.
Yeah, because they're weakening their currency quicker than you can. Even if you were trying, even if Trump tried to weaken his currency, the rest of the world at this point is just, it's called loose policy.
Well, and this goes back to a topic we've spent quite a bit of time on. Again, if you're dealing with fiscal expansion and monetary tightening at the same time, those elements, it's impossible to expect a weakening currency because of the knock-on effects in the foreign markets. Because when you start tightening monetary policy here, you're going to see an increase in flow into the United States. Tightening in monetary policy here means an increase in interest rates, which makes our bond market more attractive, relatively speaking, to the rest of the world, and puts currency pressures on the emerging markets.
Well, and one of the promises that Trump made was to basically decrease the trade deficit that we are running with other countries, which puts them at a surplus. So the U.S. current account, which has to do with those deficits and surpluses, the current account is going to shrink.
So as if the U.S. was not already involved in the global currency war, we will, under Trump, be asserting our role as sort of the superpower in the conflict.
Right.
And you're right, shrinking the U.S. current account, which, I mean, I want to repeat this like a brokered record till its significance is just flat obvious. Shrinking the current account is the most emerging market disinflationary event imaginable. The U.S. dollar liquidity, which has fed growth in the emerging markets for the last 15 years, is what gets taken away.
It's like shutting off their air supply, putting a hand over their mouth and they can't breathe.
Yeah, you take away the liquidity and you get a significant emerging market crisis. We've seen those kinds of emerging market crises in Asia in the late 90s, in Mexico in the mid-90s. And it's pretty consistent. You start tinkering with the current account and there's knock-on effects. A significant emerging market crisis, what does that reinforce? It reinforces currency pressures, that is downside in your emerging market currencies, and it exaggerates demand for U.S. dollars. So when you have exaggerated demand for U.S. dollars, it increases the U.S. dollar exchange rate. And this is a classic negative feedback loop. Higher U.S. dollar values relative to other currencies reinforce the disinflationary trend abroad. And again, that serves to increase the U.S. dollar value in the foreign currency markets. So again, if that sounds circular, it is circular, not in reason, but in cause and effect. And there is that knock-on effect to the degree that we continue to see this goal of shrinking or elimination of the U.S. current account. Guess what you've got? Major emerging market crisis.
Well, and let me throw an aside in. Sometimes people think strengthening dollar means their dollar buys more. That's not the case at all. We could have a strengthening dollar and high inflation here in the United States.
Well, and strengthening dollar does increase your buying power in terms of imported goods.
Yeah.
But here we've got the stated objective, again, of increasing U.S. jobs, increasing U.S. manufacturing, and increasing exports, as well as the products that are manufactured and bought here domestically, which a U.S. dollar doesn't really help you with a number of those things.
Well, let me challenge the model a little bit, because there's something that's replacing people all over the world, and it's a scary phenomenon. It's going to happen. But what about robots? Because anything that you can repeat over and over, including orders from a Wendy's restaurant, that can actually be turned into an automated process.
I felt like there was a gaping hole in our conversation a few weeks ago, because this is a really critical thing. Something we've left out of the conversation is that the vast majority of lost jobs in the U.S. manufacturing space have not been lost to overseas workers, but have been lost to robots. We've got technological innovation and productivity improvements, which are a massive factor to consider, and I think supersede offshoring, quote unquote, because if the idea that Trump is fighting for is to bring U.S. jobs back, put that in reverse, so you've got now onshoring, and that is to bring jobs back into the manufacturing space.
Right.
Kevin, many of those jobs simply don't exist anymore. If you look at labor cost reductions, it's sort of 2 parts wages to 4 parts automation. So yes, there's some marginal benefit to moving plants overseas, but quite frankly, you've got automation in overseas plants as well. So what are you bringing back exactly? I mean, this is a real estate deal, if anything else. Bring the plants back, build the plants here, but guess who's not going to be staffed? Hundreds of thousands of formerly employed U.S. manufacturers. Why? Because again, automation has been with us since really the year 2000.
So even though some jobs may come back to the United States, the amount that are being counted on, especially having to pay workers in U.S. dollars at U.S. wages, it's going to be a robot.
Well, and that's why we said last week that we would expect anything made in the United States and consumed in the United States to cost 5 to 7 times the amount as compared to manufacturing overseas. Because the wages that are involved, even when you assume that automation makes up a lot of the workflow, the wages that are involved are considerably higher.
And you're still seeing the U.S. dollar strengthening. I remember when we talked to Russell Napier just a few weeks ago. From an outsider's point of view, someone sitting in Scotland looking at the world markets, he expected a strengthening dollar. Now, he expected strengthening gold at the same time, and that's what I want you to address. Okay, so the U.S. dollar weakening is not really an immediate possibility.
Well, and just before we move on to that point, it's an important one, but I think as parents, as grandparents, it's really necessary for us to think about this changing world of automation and technology, because quite frankly, if any repetitive task can be done more cost effectively with a machine, that trend is going to displace working people in the future as well. So when you're sitting down with your son or grandson and you're trying to give them advice, it's going to be a totally different set of advice today than it would have been 20 years ago. Right. You can't read the book, What Color is Your Parachute, and expect to land firmly on terra firma in a job that gives you security for the next 20 to 30 years. And so again, I think it's important to think about what is changing. We've got many benefits from technology. But as you're counseling people in your family, recognize that there's going to be a lot of job obsolescence over the next 20 to 30 years. So your point, back to Willem Buter's comment in the U.S. dollar, the U.S. dollar weakening, it's not an immediate possibility. It's not an immediate possibility if on the one hand, you've got fiscal spending, and on the other, you've got monetary tightening in play. You have to watch out for emerging market pressure. Where does that pressure show up in terms of market pricing? It shows up in emerging market bonds. It shows up in emerging markets currencies first, and really first and foremost, because if you do have much of a devaluation trend continue in the emerging markets, you could actually see some benefit, some upside in emerging market stocks.
Well, what about the stock market?
Yeah, and I've heard the saw so many times that on a relative basis, your emerging markets are much cheaper than the developed markets. And that's true. But there are some factors like trade wars and currency wars that can make cheaper still.
Well, let's go back to gold for a moment then, taking this into consideration.
Well, right. There's this final conclusion, which that demand for gold has already begun to reflect overseas traffic. And again, we're talking about something that's already occurring in terms of emerging market stress and emerging market economic decline. And as people anticipate trade wars and tensions with the United States, looking at the cabinet that he has, that is, Trump has put in place, we've got folks overseas who are getting nervous, and gold demand is likely to step up on a continued basis overseas. But again, back to that second point, I think it's also likely to step up in the U.S. Why? Because U.S. equities, I think, are eminently to come under pressure.
Well, wouldn't you say the United States is just amazingly distracted at this point? We never let the election actually finish. We were distracted for about 2 years as we moved into it. And then Trump taking over actually was such a surprise that the distraction has continued. So U.S. investors, no wonder they're not buying gold. They're watching the news. I know when my wife calls her parents, I asked her father the other day, what have you been reading? And he's retired and he loves to read. So he always has 3 or 4 books that he's read by the time I talk to him. And he said, oh, I'm not really reading right now. He says, about 80% of my time is spent watching the news. Well, why? Because they're distracted. They want to know what the next thing Trump's going to say, whatever comes out of his mouth. It's entertaining. Right now, the rest of the world's nervous.
That's right. And that's why the last $100 improvement in the gold price has been attributable entirely to overseas buying.
Right.
Because U.S. persons are very intrigued by the Dow above 20,000 and not very intrigued by anything else, which just speaks to our ability to sort of contextualize and interpret information.
How many times, Dave, since you've been born, has bullish sentiment been high like it is now, right before a major crash?
Investor Intelligence Advisors survey has positive or bullish sentiment at the highest level since 2007.
Well, does that ring a bell? 2007?
Those are the market top. And it's not a coincidence that the Dow is at extremes at the same time. When you look at the Dow Gold ratio, you're sitting at an extreme counter trend level. What do I mean by counter trend? Because that trend has seen a shrinkage in numbers from 44 down to 6 circa 2011, and we're back around 16. So you would expect with softness in the gold price and strong pricing in the Dow to see that number have given some ground back. And in fact, the Dow Gold ratio has.
I want to go into detail on that a little bit later, okay, because it can be sort of confusing, but there is a counter trend. Anytime you have the Dow Gold ratio go from its high down to, say, 3-to-1, 2-to-1, or 1-to-1, there's always been a counter trend, then a top.
Although we never did get that low. We got to 6.
We're not there yet.
That's right. Yeah, I think, unfortunately for Donald, he's inheriting a stock market which is similar to Hoover's. Hoover was considered a shrewd, business-minded leader, but honestly, his timing couldn't have been worse. To be caught holding the bag in 1929, it was not Hoover that created the Great Depression. It was Hoover who was forced to deal with what was given to him. He inherited an over-leveraged system. He inherited a stock market that had been priced for perfection. And even though he had business acumen, do you know what he was able to do with the chaos that the market threw with him? Zip, zero, zilch, nothing.
Right.
There was nothing that he could do because, quite frankly, the man in the Oval Office does not determine the direction of the market or the economy.
Right. And he inherited the reputation of just a buffoon when actually that wasn't the case at all. Now, something that has occurred, Dave, 1987 was my first year here. Something that was occurring at that time, that occurred in 1999 before the crash, that occurred again in 2007, is the mutual fund management community feels tremendous pressure when things are so bullish to have cash sitting in an account. You know this yourself as a money manager. To have cash sitting in an account is almost heresy. And so what happens is the mutual funds, instead of their cash being 7, 8, 9, 10%, it whittles down to, 5, 4.
That's right.
And if it gets down into the 3s, it's always a crash because they're out of cash. There's nothing left to spend in the market.
Well, the job's on the line if a mutual fund manager isn't keeping up with the competition, and they're constantly being harangued by clients to say, I'm paying you for what? Why is cash on the sidelines? I thought your thematic was to be fully invested in this, that, or the other.
Right.
And so what happens is as prices rise, again, more money gets pumped into the market. Ergo, we have a cash to asset ratio at mutual funds at a record low. We have that today. It was Stephen Hochberg and Peter Kendall's recent research where they pointed out that 1973, as the stock market peaked, again, roll the clock back to the 1970s, early 1970s, stock market peaked and the ratio hit a low of 4%. That's 96% invested, 4% in cash. There is a huge disdain for cash at a market peak.
Yeah, why own it?
And this time, the same coincidence occurred in years 2000 and 2007.
Yeah.
Stock prices reached what, in retrospect, were unsustainable highs. And where was the cash to asset ratio? Sitting at 4% in the year 2000, similar to where it was in 1973. And then for the first time, it reached 3.5% in 2007. And that was, again, as bullish enthusiasm was blinding investors to risk. And what they were preferring to focus on was the possibility of greater and greater reward.
Well, where are we now?
Now 2017 rolls around and we're at 3%. Just to reiterate, what followed these low readings of cash with mutual funds, the cash to asset ratio, was a consistent move 48 to 58% lower in equity prices. I don't hear warnings from Wall Street. I don't hear caution from the business news outlets. What I hear is cheerleading for Dow 30,000.
Yeah.
And I mean, amongst the many neglected but relevant facts, which, I mean, what news media loves to do with those is just kind of sweep them under the carpet.
Well, one of the things you look at to see if the economy is actually supporting it is just how much is coming in tax receipts.
Tax receipts. So total federal tax receipts year over year have declined for the first time since 2002 and 2009.
Those are recessions.
That's right. So you've got individual tax receipts also, which have slid year on year. We've got corporate tax receipts, which fell 12.4%, according to Meridian Macro Research. Only with non-GAAP earnings can investors remain enthusiastic with corporate financial performance. But if you're looking at things, again, what is GAAP versus non-GAAP? Generally accepted accounting principles.
Right.
Non-GAAP is how do you fudge the heck out of the numbers and tell whatever story you want so that you keep the investment parade going a little bit longer. That is what non-GAAP means.
That's perception management again.
But on a GAAP basis, corporate America is in a 24-month systemic decline. Okay? But again, we don't report on a GAAP basis anymore because bad news bears come out, and now you've got to give them airtime too, and that's not what you want to sell product and sell advertising.
Well, yes, Dave, the Dow is up. Stop talking negative.
The Dow is up. So who cares about corporate taxes? But think about this. Think about this. If corporate America is on the mend, the one place you don't want to be caught lying is with the IRS, right? Tax numbers are kind of important, and they kind of tell you something significant. There are games, and there is reality. But how does Barron's sort of pretty up this pig? How does Barron's talk about it? I quote from Barron's in the article which was pushing Dow 30,000. It sort of is the next destination. Today's stock prices are well supported by corporate earnings and economic growth.
But what you're basically saying is it's possible that we could have a 48 to 58% drop in the stock market, given the numbers you've talked about. Dave, you're talking about a 10,000 Dow, not a 30,000 Dow.
For the uninitiated, a 48 to 58% decline, that's a crash.
Yeah.
That's a crash. And that does imply a move to 10,000 on the Dow. That's not out of the question. And you have to have buyers to drive prices higher.
Right. And the mutual funds are out of money.
That's right. So when you run out of buyers, you run out of price improvement, you run out of momentum. So, I mean, you know what we're doing right now? All we're doing is counting the last buyers in.
Right.
And does that happen this week? Does it happen next month? Does it happen 3 months from now? Oh, that I don't know. I don't know. But I can tell you that mutual funds are all in. They're all in. And in a game of poker, when everyone's all in, that's it. You got to show your hand.
Well, the other thing that it causes is there are no buyers as it falls. It forces more liquidations of stocks. When something like that happens and there's no cash in the market, these mutual funds can't go in and bargain hunt when the market does go down. They are eliminated as a market-saving mechanism.
Right. So when sentiment in stocks is strong, and I think this is the key takeaway for the second point in terms of why gold, I think, is going to do very well in the next couple of years. When sentiment in stocks is strong and price action is positive, demand for gold in the U.S. is relatively low, particularly amongst the public. But the opposite is also true. You see a snap in sentiment. You see a change in confidence levels, and guess what happens? People start looking desperately for alternatives.
Dave, you've for years recommended people not necessarily look at the Dow in dollar terms because the dollar can be printed. We talk about the dollar going up and down. Over time, the dollar devalues. But probably the best measure of the Dow and one of the better measures of gold is to put the two together, and it's the Dow-gold ratio. You were talking about an interim peak on the Dow-gold ratio, and now as it drops, and this is sometimes backwards thinking, but keep in mind, as the Dow-gold ratio drops from where it was 44 to 1 all the way down, say, to 3 to 1, 2 to 1, or 1 to 1, as it's dropping, the price of gold is rising relative to the Dow. In other words, how much stock can an ounce of gold buy?
Think of it as a measure of market preference, a preference for paper versus real assets. Okay, so there's times in history where there is definitely a preference for paper, and stocks will do very, very well. And you think, okay, well, great. That would be right now, correct? Yeah. We're at all-time highs. And there should be less of an emphasis on real assets in that kind of time frame. But the ratio tells you a very different story. It tells you a very, very different story. And if you want to know where we're at in the continuum as an investor, where we're at circa 2017, it's very important that you pay attention to the ratio. The ratio implies that Mr. Trump is coming in at a counter trend extreme with the number, again, the Dow gold ratio, dividing the Dow by the current spot price of gold. It's about 16.5. Yeah. Now, where is the spectrum? The full spectrum is 1 on the low side and 44 on the high side. 6 was the number we reached in 2011.
Right.
1 or 2 is what we anticipate over the next 3 to 5 years.
That's where the big move actually happens.
Absolutely. And Trump comes in at a phase where the ratio is actually kind of on the other end of the continuum. say, in contrast to where the Reagan era of policy and politics
Reagan
began.
came in at 1-to-1. I mean, he couldn't lose. At that point, the stock market has to go up relative to gold.
Well, that's right. Reagan emerged as president with the Dow Gold, right, let's say it was 2-to-1, followed by that extreme, which was set at 1-to-1. And as we've said before, Reagan emerged a little bit like Erdogan in Turkey. You know, when Erdogan came in to power, the lira was at a low, stocks were at a low, the economy was on its back, and Reagan shared that kind of common thematic. He came in at a pivot point for everything. He came at a pivot point for stocks, bear market lows and ready to turn higher. Bond market was absolutely in a crushing era of high interest rates, and the value of bonds had been squeezed to virtually nothing. The dollar, and in this case, gold and its ratio companion to the Dow, I mean, all these things were in flux. He came in at a pivot point. But Trump comes in at the opposite extremes, the other end of the spectrum. Look at bonds, look at stocks, certainly. The ratio between gold in stocks is not at 44, where it was in the year 2000, having retained most of the progress since that time. Think about that. The Dow is at all-time highs, and we should see gold, a completely worthless asset, on its butt. And where is it instead? No, it's not at 44-to-1. The ratio is not at its all-time highs along with the stock price. It's at 16-to-1. This is very key. This is absolutely critical. Study the relationship and it will tell a more important story than the nominal value of the Dow. In essence, the Dow, even though it is at all-time highs, in real money terms, that is gold ounces, it remains 62.5% below its year 2000 levels.
Right.
Let that sink in.
Yet, Dave, the positive sentiment, if you were to weigh things out right now, is still in the stock market.
And what is that based on? That's based on some sort of a fantasy, some sort of a chimera. I mean, Trump made the political freshman's mistake of claiming responsibility for this last up move and getting enthusiastic about getting past the 20,000 mark. Because remember, before he was elected, he was describing the stock market as a bubble. Yeah. And now that he's president, we kind of talked about this before the election. He's got to own it. And he's going to go from being critical of the Fed to being dependent on the Fed, because guess what happens if the bubble bursts on his watch?
Well, the likelihood is he'll be holding the bag, and the mainstream media is going to be waiting for him to fumble.
Well, isn't that right? I'm sure the mainstream media will treat him kindly, don't you think? I mean, I am sure that fears of further decline won't be like flames fanned by an ingrained media bias. I mean, right. That's where, if you want to see rabid dogs feeding on flesh, Trump unfortunately set himself up for that. If prices are not maintained at high levels in the Dow, he's going to be criticized for the stock market collapse, because he already took credit for the stock market, quote unquote, Trump effect.
Another ratio that we watch very closely is the silver-gold ratio. It's not just when to buy silver or when to buy gold, but a lot of times it actually tells us where we are in either a bear market or a bull market in gold and silver in general.
I'm running out of ounces at home. I generally keep 20, 30 ounces there, and the kids love to spend their allowance filling their own treasure boxes with ounces of silver.
Right.
And there was a raid this last weekend. A raid. I had two boys and a girl saying, well, what's the price? And of course I have some sort of a matching program where, they actually are buying it at a discount. It's the best deal in town. The day they buy silver, they automatically have 100% gain. I mean, it's kind of cheating in terms of teaching your kids about the value of money and investing, but they've figured it out.
They'll always remember the matching program from Dad.
That's right. And allowance is actually a 2-for-1 special if you put into gold as opposed to buying it, bubble gum or Legos. But, watching the silver market, and I sometimes tell them about this, which may be why there was a run on silver. Silver broke the pattern of lower lows and lower highs if you're looking at a silver chart. In other words, it's starting to move up out of its recent 4 or 5 year downtrend, right? So that's a positive sign. You also have the gold-silver ratio, which has long been stuck above 70, and it is on the verge of coming back to life, implying that you've got outperformance in the white metal. So translate this. If growth is your game, then silver is a more attractive play than gold. Seeing the ratio move back into the precious metals bull market range of between 40 and 60 on the ratio, what does that tell us as practitioners? What that tells us is that we have a confirmation of a multi-year move higher in the metals. Current level 68.5. And as you're watching the ratio get closer to 60, I say consider a reorganization of a metals portfolio from under allocation of silver to at least equal allocation to that of gold.
Well, and I think that's important to note. You don't sell all your gold necessarily, but you swap some of your gold into silver at this point so that you can go back into far more gold when you get down into that 40-to-1 ratio, 30-to-1 ratio.
This range is really important. It was Ian McCavity who was always fond of the chart contrasting the trading dynamics of these two precious metals. In a bear market, whether it's a secular, that's a long-term, or cyclical, shorter-term bear market in precious metals, he would say it doesn't matter. Silver in a bear market grossly underperforms.
As we have seen. I mean, in this, even this cyclical bear market, we saw silver drop from 49 down to what, 14?
13 and change.
Yeah.
I mean, so a blistering pace to the downside. Gold gave up the ghost, but not quite the way silver did. In a bull or growth phase, on the other hand, silver outperforms. So for McCavity, what defines the transition is whether or not you're above 60 or below 60.
Well, and we've got a little bit of a preview, Dave. We don't have to wait for the metals to do what you're talking about because the mining shares oftentimes lead the pack.
That's right. And you've had silver mining companies which have outperformed. That is, for the last 12 to 16 months, they have been much more beneficial to own than your gold stocks. Being aware of that ratio, it'll tell you the power or lack thereof of the bull market that's ahead of us. So again, a drop below 60, that is ounces of silver to 1 ounce of gold, that's a massive confirmation of the trend.
Well, and this is a wonderful time to be looking at these things because the Americans, the United States, they're looking the other direction. I mean, who's really buying the metals right now?
Well, who's buying, who's selling? As stocks have motored higher in the post-election period here in the U.S., you've had the gold ETF, that is GLD, the most popular one. It's seen 43 tons of liquidations.
That's out of the United States, though.
Yeah, and that's U.S. investors not interested in the month of January. Okay, so they're moving out. You've had large speculators which have been jumping ship, and this goes to the futures market. They've been jumping ship since midsummer. They've continued to liquidate through January, the equivalent of 625 tons. Again, this is in the futures market, so you're talking about hundreds of thousands of contracts, not actual physical metal moving. But again, the large speculator and the investor in a gold ETF here in the United States, they're moving to the exits. So who is it now? It's the Japanese, it's the Chinese, it's the Russians, it's the Turks, it's the Germans that are buying. December gold imports into China were larger than in any month over the last 3 years. You've had Swiss gold exports to China, again, going back to December, which were up 400% in December. This is just before the Chinese New Year.
It's amazing, the contrast, Dave. Folks in the United States are selling. Everybody else in the world is increasing buying.
Well, notice the tone and tenor that Trump has set in terms of global trade.
Yeah.
Are the Chinese set on edge or put at ease by his commentary? Is a Chinese investor thinking that there's going to be greater global trade and cooperation, or a strain in the relationship, which means that not only is there a problem in terms of product flow and capital flow, but ultimately, maybe even in terms of a flow of tanks and bombs and guns.
Yeah.
I mean, the way things get resolved in the final analysis when you have a financial problem is somebody starts a war and that distracts the people, and that makes sure that the people who are entrenched in political office don't lose their jobs. But back to gold in China, because in January, you had Chinese investors who kept on buying the physicals. The export numbers from Switzerland were a big part of that. The import numbers were huge as well from a variety of sources other than Switzerland. But then you also have the increase in buying via the Chinese gold ETF. So these might be shorter term buyers. Mm-hmm. But nevertheless, here in the early part of 2017, you've got long-term investors and short-term investors in China accessing the market. The America First rhetoric, I mean, again, the potential for trade war where currency values may be the first casualty, that has a global audience for gold swelling.
Well, and it's not just Asian. I mean, we're seeing European buying right now in the ETFs as well.
Yeah, the gold ETFs that have seen the largest dollar inflows have actually been in Western Europe. And you had one German ETF, which had about 544 million investor dollars come in 1 week here in the last 30 days. So you've got politics, you've got geopolitics. These are as it turns out, relevant factors that drive the gold investor to shift allocations from cash to gold. I mean, look, we've got the gentleman from the University of California, Irvine, Peter Navarro, who's now heading up Trump's National Trade Council, and he's doing a masterful job, stirring concerns both with the Chinese and with the Germans. And, I forgot, Japan, and we noted this last year, Japan has also been a considerable buyer in the gold market with an uptick in gold buying there as money printing. I mean, look at their monetary policy. It's full-blown reckless. It's full-blown reckless and desperate. And the average Japanese saver, it has not been lost on them that when a government is buying stocks and bonds and they are the buyer of first and last resort, something is not sustainable, something is healthy, and something will not end well. So any surprise there that the Japanese are gobbling up gold?
Well, we've seen the Turks, we've seen the Russians, we've seen the Indians. I mean, they're buying with both hands at this point.
Erdogan has basically said there's a conspiracy by Western powers against Muslim nations and specifically Turkey. And he points out that the lira, which has been in collapse, the lira, the Turkish currency, which has been in collapse, needs the support of domestic buyers. So if you're sitting there on euros or dollars or any other currency in your couch cushions or under your mattresses, you get it out. And he said, do one of two things, buy gold or buy Turkish lira. Lo and behold, Turkish gold imports jumped 688% in December.
Well, it's not just that. I mean, look at even Putin's country. 200 tons was added to the reserves.
Right, but think about this. Turkey is the fourth largest importer of gold in the world. And December a year ago, 2015, they brought in 4.7 tons. Nothing to sneeze at. I mean, that's still real gold on real pallets, taking up real space. 4.7 tons was imported December of 2015. That jumps December of 2016 to 36.7 tons. A pretty significant increase.
Well, and Turkey is a Muslim nation, and a lot of people have looked at the news here recently and said, wait, under Sharia law, you can now buy gold. We've discussed this in a couple of commentaries, but it's important to go back and say, all right, this represents over 1 billion people in the audience that can now buy and sell gold in a portfolio legally under Sharia law.
Right. So what we're talking about is the Sharia policy, which impacts around $2 trillion involved in the Islamic finance market.
Okay.
And there's strict laws that apply to be Sharia compliant, to be consistent with the Quran. And you're right. This impacts 1.6 billion people, over 100 million investors. Is Mark Mobius of Templeton Asset Management, who said in Dubai at a gold conference here in recent weeks, this Sharia gold standard is a godsend for those Islamic households that would like to invest in gold funds.
Yeah.
This is a big deal. Mobius is emphasizing the importance of the fact that the new Sharia gold standard is all about the ownership of the underlying asset. He's talking about allocated physical gold coins and bars. And it was very interesting because in the presentation that he gave over in the Middle East, this is the presentation he gave. He said, look, it's pretty well established that there's not enough transparency to hold your gold at the Fed or with other central banks. And the Sharia gold standard is necessary in order to bring transparency required by this particular community because they don't really want to be gamed. You know what? I think that's pretty savvy.
Well, and this is an amazing economic phenomenon.
It's the single most important thing that has happened to the gold market in the last 24 months, and yet it's not getting very much press. Why? Well, it's latent demand, it's future demand, and that's what you were getting ready to say.
Well, what I was going to say is, yeah, anytime you add only demand, because this is a market that's been shut out up to this point in something that has limited supply, you better come up with new supply or you're going to have higher prices.
Right. This is where, again, if you're looking at 2017 and 2018 as a very interesting time and a very beneficial time to be invested in anything gold or silver related, this is it.
Yeah.
Add to this the supply dynamics. You've got in the mining space, we are hitting a wall as we speak. We have 10 to 15 million ounces a year coming to market in new discoveries. None of those are large discoveries, but if you cut and paste all the little properties that are bringing new product to market, it brings the total to about 10 to 15 million ounces a year. That's new discoveries. What do we need to keep up with demand? Oh, only about 90 million ounces a year.
Right.
So from an exploration standpoint, we are way behind the curve. And by the way, the minute you find a discovery, you're still counting 5 to 7 years before you can put it into production. So, I mean, this is where I think it's absolutely fascinating. No one's really paying attention to the gold market. Nobody's really paying attention to something that for the last 5 years
in the United States.
Well, you're right, because
in the United States,
in Japanese terms, in euro terms, in other foreign currency terms, gold is not on its back. It's actually performed pretty decently. 2016 was a good year for gold.
Even in the U.S.
Even in the U.S. But I just think in advance of the maddening crowd storming for the ounces of gold that are available on the market, I would encourage you to consider your allocations. I would encourage you to aggressively double them if possible. And maybe I'm getting a little enthusiastic. Okay. But the supply and demand imbalances are already here. The demand side is from a host of investors around the world. And as we've discussed earlier in the program, it's set to swell for a variety of reasons. But when the demand side is lining up in your favor and the supply side, you can't do anything about it. That's what supply inelasticity is all about. You want to double the amount of gold in production? This is not like running an extra shift at the manufacturing plant and cranking out more widgets. You can't go dig it out. You can't get it out of the ground to meet supply. So what happens? It triggers a massive increase in price. We'll talk about this more as this unfolds in 2017 and 2018, but I think that's exactly what we have in front of us.
Thank you for listening to today's McIlvaney Weekly Commentary. We'll see you next Wednesday. Be sure to follow us on Twitter at ICA Gold for our latest updates and market thoughts. You can follow David at David McIlvaney. That's spelled DavidMcAlvany. And if you want to learn more about us and what we do, visit us online at McIlvaney.com. Or if you have questions about precious metals investing recommendations, give us a call at 800-525-9556. We've been in business for over 40 years, and we have a number of experienced advisors who can help you with your questions.
This has been the McIlvaney Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McIlvaney Weekly Commentary.